All right. Well, hello everyone. This is my working capital presentation for the class of Finance 711. Right here. Financial measures value of value added. My name is Nelson Serrano at University of Phoenix with Professor Dr. Craig Martin. Okay, from here on forward, I'm supposed to pretend that I am the Chief Financial Officer giving a presentation to the company. So let's begin. Feeling our future, a guide to raising capital for expansion. Understanding our financial stakeholders. Nelson Serrano, that's me, the Chief Financial Officer. I wish. All right. So, hello everyone. As you know, we are at an exciting inflection point with a significant opportunity to expand our products and services. To seize this opportunity, we need to raise capital. Over the next few weeks, we will be meeting with various potential financiers. This presentation will provide a clear overview of who these players are, what motivates them, and how they can help us achieve our goals. So let's begin. Here's what we will cover today. First, we touch on our strategic goal. Then, we dive into our four main types of financial stakeholders we will, we will engage with. We will compare them side by side to understand their unique characteristics. Finally, I will present my formal recommendation for which type of financing I believe is the best fit for a company at this stage. And then we will open the floor for questions. We have a well defined plan to expand our product and service lines. This is not just about growing larger, it is also about achieving strategic growth to meet apparent market demand. The critical next step is securing the necessary funding. The how is what we are here to discuss. Finding the right financial partner is just as important as the capital itself. Stakeholders 1, business angels. Business angels, think of these as successful, wealthy individuals, often former entrepreneurs themselves, who invest their own money directly into companies. While they are most famous for funding startups, they sometimes invest in established companies poised for growth. Beyond money, their value can be the hands-on mentorship and the network they bring to the table. Business angels, motivations, resources, and risks. Okay, so what drives a business angel? Primarily, it is the potential for a massive return on their investment. But many are also motivated by the thrill of helping build a successful company. Their resources are their cash at hand, crucially, their Rolodex, in other words, their contacts. The risk for us is that this personal involvement can be a double edged sword. We will gain an expert, but also a voice that might be more hands on than we would like. Their capital is also finite. Stakeholder 2, venture capitalists or VCs. Unlike angels, VCs are not investing their own money. They are professional fund managers investing on behalf of large institutions. They place big bets on companies they believe can grow exponentially. In return for their extensive checks, they take a significant ownership stake and expect to have a formal say in the company's strategic direction, usually from a board seat. Venture capitalist, motivations, resources, and risks. VCs are motivated by one thing: generating massive returns for their investors. They have deep pockets and provide invaluable resources for rapidly scaling a company. However, this comes with significant risks. Taking VC money means accepting immense pressure to grow at all costs. We would relinquish a substantial amount of control and ownership, and we would be subject to their timeline for an exit, whether that involves an IPO, initial public offering, or the sale of the company. Stakeholder 3, banks. Now, for a more traditional route, banks. Banks are fundamentally different from angels and VCs. They are not buying a piece of our company. Instead, they are lending us money that we must pay back. The primary concern is our ability to repay the loan, so they focus heavily on our past performance, profitability, and assets. Banks, motivations, resources, and risks. A bank's motivation is simple: to safely earn interest on the money they lend. They are not betting on our future success as much as they are ensuring we are a low risk borrower today. The main risk for us involves the strict terms. Loan agreements often contain covenants that limit our operational freedom, such as maintaining a specific cash reserve, and of course, if we fail to make the payment, we would lose the assets we have pledged as collateral. Banks always ask for collateral. Stakeholder 4, financing companies. Finally, let us look at financing companies. These are another type of lender, but they operate in a specific niche: asset-based lending. Instead of examining our entire business, they focus on the value of particular assets. For example, they might give us an advance on the money our customers owe us, or provide a loan secured solely by a new piece of equipment we want to buy. Financing companies, motivations, resources, and risks. Financing companies are motivated by earning fees on relatively safe collateral backed loans. They offer a quick way to unlock cash tied up in our assets. The primary downside is the cost. Interest rates are typically higher than those of banks. They are an excellent tool for managing short-term cash flow needs. However, they are not a typical source of long-term strategic capital for a significant expansion. Recommendation for our expansion. So, after careful consideration of all our options, I recommend that we pursue traditional bank financing to fund our expansion. We are not a startup, we are a mature, profitable company. This makes us an ideal candidate for a bank loan. This path enables us to obtain the capital we need at a reasonable cost without relinquishing any ownership or control of the company we have built. It aligns perfectly with our ethos of smart, sustainable growth. The goal here is to maintain 100% ownership of the company. Pros and cons of bank financing. Of course, no option is perfect. The primary advantages of using a bank are clear. We maintain our company, the interest is a business expense, and it is the most cost effective form of funding available to us. On the other hand, we must be prepared for a rigorous application process and we and be willing to accept certain operating constraints defined in the loan agreement. We must also be comfortable pledging assets as collateral. I believe the pros far outweigh the cons, these manageable cons. Then on to our next steps. Here are immediate next steps. The finance team will finalize the projections that will form the core of our loan application. We will then package this information and initiate formal discussions with our current bank, as well as two others, to ensure we secure the best possible terms. Our goals, our goal here is to have a firm commitment in place within the next quarter. All right. Questions and discussions. If no questions, that concludes the formal presentation. I'm happy to answer any questions you may have about these stakeholders or my recommendations. No questions? Okay. Thank you very much. It was a pleasure. Have a great day.